Hi everyone, welcome to my channel. I am Dia Indra and I am one of an MBA student of IPMI International Business School. This time I will tell you about Corporate Finance Mind Map. Corporate Finance is one of the class at the MBA program and we talk by an amazing lecturer, Professor Roy Sandberg. And this is the mind map of corporate finance that I've met. We learn about 10 topics for 7 weeks. It's about financial management, time value of money, capital budgeting, analysis of securities, portfolio investment, capital structure, corporate restructuring, fraud risk management, international finance, and dividend. At the first week, we learn about financial management and time value of money. Financial management like an optimal orchestration of internal and external financial resources towards significant and sustainable value creation. The goal of financial management consists of 4 objectives. Basic objectives like profit maximization and wealth maximization. Operational objectives such as timely availability of requisite financial and etc. Social objective like payment of reasonable dividend, payment weights, and etc. And then research objective about researching into new and better source of finance. And what to manage? Capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. And then we learn about the corporation and financial market. It shows us the cash flow between the firm and the financial market. We also learn about principal agent problem that consists of asymmetric information, moral hazard, and conflict of interest. After that, we learn about value creation that consists of core of value principle. It's about combination of growth, ROIC, and healthy cash flow. And then conservation of value principle. Value is created when company generate growth, ROIC more than WACC, and higher cash flow. And then, based on a principle, a business value depends on who owns or manages it. And then expectation treadmill principle. It's about expectation of shareholder and fundamental performance. We also learn about 5 business essentials from Prof. Ramcharan that consists of cash, profit margin, velocity, growth, and customer focus. And then we learn about time value of money, such as present value and future value by solving a case about retirement planning. At the second week, we learn about capital budgeting. Capital budgeting is planning process for investment in long-term assets. There are 4 methods to calculate capital budgeting. First is payback period. It's about how many years does it take to cover the initial investment. The sooner is better. The weakness of payback period are subjective because it based on decision maker reference, not consider time value of money, and not consider all cash flow. And the second method is net present value. To calculate present value of all cash flow, this decision rule is accepted if NPV more than 0. The third method is profitability index. The decision rule is accepted if PI more than 1 and rejected if PI less than 1. The PI formula itself is present value of cash flow divided by initial outlay. The fourth method is internal rate of return or IRR. The decision rule is accepted if IRR more than required rate of return. IRR is the discount rate that makes NPV equal to 0. And from all those methods, NPV is the better method for project evaluation. NPV is more conservative than IRR. If the condition uncertain, better choose a conservative method. At the third week, we learn about analysis of securities. We learn about fundamental and technical analysis. For fundamental analysis, we use the financial performance of the company, such as ROA and ROE, to know the profitability, current ratio and quick ratio to see the liquidity, debt asset ratio and debt equity ratio to know the leverage, and market ratio such as dividend yield and price earning ratio. We also analyze the healthiness of the company from 5 indicators: natural level, quality of number, historical trend, industry benchmark, and decomposition. And for technical analysis, it's about finding repeated pattern in the stock price graph. We also learn about intrinsic value versus market price. If the fair value more than stock price, then we can buy it. But if the fair value less than stock price, we can just sell it. At the Big Four, we learn about portfolio theory. There is as much as return possible with lower risk. There are three types of return: potential return, actual return, and required return. To know the return good or bad, we need a benchmark that is BI rate. And how to measure risk? We use standard deviation as the total risk of return. Total risk consists of unsystematic risk and systematic risk. Unsystematic risk has no correlation with market and can be eliminated using portfolio combination. This is called the diversification. And the systematic risk caused by overall market movement. We use beta to measure systematic risk. High risk, high return, low risk, low return. If unsystematic risk relatively high, systematic risk will be low. It means total correlation with market is low. Higher unsystematic risk, lower systematic risk, it means lower correlation with market. And then we learn how to calculate beta and capital asset price model or CIPM. The formula was found by Professor William Sharp, and as one of Professor Roy's students, I already become the great student of him. After that, we learn about capital structure. We analyze the balance sheet again. The theory about capital structure from Modigliani and Miller proved that with tax deductibility of interest payment, the optimal capital structure is 100% debt. Levered firms pay less in taxes than does the all-equity firm. There are some factors that determine optimal capital structure, such as profitability, tax rate, volatility of cash flow, and credit rate. At corporate restructuring, we learn about process integral financial distress, outcome of financial distress, surviving and transforming business, restructuring corporate structure, and LBO. The value creation of LBO are lower WACC, new management to reduce conflict of interest, tax shield benefit, reduction of too much free cash flow, and conglomerate discount. From fraud risk management, we learn about occupational fraud and abuse, fraud triangle, whistleblowing system, and 4 types of incentive, that is physical, monetary, social, and moral. After that, we learn about international finance, about foreign exchange market, foreign exchange transaction, currency future and option market, arbitrage strategy, international arbitrage, and exchange rate big picture. There are 2 types of option contract. First, American option. The rule is one-time use right on the period, and the second one is European option. The rules is only executed at the end of the contract. Arbitrage is practiced to take advantage from the difference price between 2 or more markets. At last, we learn about dividend. Why companies should pay dividend? There are several reasons. First is paying dividend relevant to tax, because tax from the capital gain will be different from dividend. And the second, it means our cash is really there at the company. It's signal that cash is there and can generate cash consistently. And the third, for value creation. If the cash still there, it means comfort zone for the management. Pay dividend make the management think how to improve productivity or profit. That is all about corporate finance that we've learned from the class. Actually, this knowledge is so much useful for me and help me understand how a company should be managed based on the financial condition. Hopefully, this is useful for you too. Thank you for watching and don't forget to like. Bye-bye.